Have you ever felt like something is holding you back from building the wealth and success that you dream of? In today's video, we're going to talk about the common money traps to avoid for financial success. These are the mistakes that many people make, especially those who belong to the middle class, which can prevent them from building wealth and reaching their full potential. By avoiding these traps, you can improve your financial situation and create a better future for yourself and your family. If you want to avoid these traps, well, stick around. This is the Finance Virtuoso channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to click the notification bell and hit the subscribe button now. The first money trap to avoid is overspending on credit cards. Credit cards can be a useful tool for building credit, earning rewards, and having convenience. But they can also be a dangerous trap if you don't use them wisely. Many people fall into the habit of spending more than they can afford on their credit cards, and then paying only the minimum balance each month. This can lead to a cycle of debt, where you end up paying high interest rates, fees, and penalties, and never making any progress on paying off your balance. According to Experian, the average credit card debt in the United States is $5,313 per person, and the average interest rate is 16.28%. That means if you only pay the minimum payment of $106 per month, it will take you 10 years and 7 months to pay off your debt. And you will end up paying $6,629 in interest. That's money that you could have used for saving, investing, or achieving your other financial goals. So, how do you avoid this trap? The best way is to pay off your credit card balance in full every month and never spend more than you can afford. This way, you can avoid paying any interest, fees, or penalties and enjoy the benefits of using credit cards without the drawbacks. If you already have credit card debt, you should make it a priority to pay it off as soon as possible by paying more than the minimum payment. You can also consider transferring your balance to a lower interest rate card or consolidating your debt with a personal loan. But make sure to read the fine print and compare costs and benefits. The second money trap to avoid is buying a new car. A new car can be a tempting purchase, especially if you want to impress your friends, family, or coworkers, or if you want to enjoy the latest features and technology. However, buying a new car is also one of the worst financial decisions that you can make, because cars depreciate rapidly, and you end up paying a lot more than the car is worth. The average new car costs $40,573 and loses 23.2% of its value in the first year. That means you lose $9,415 in the first year alone, just by driving the car off the lot. And that's not counting the other costs of owning a car, such as insurance, maintenance, repairs, gas, and taxes. If you finance your car with a loan, you also have to pay interest, which adds to the total cost of ownership. According to bank rates, the average car loan interest rate is 4.21% for a 60-month term. That means if you borrow $40,573 for a new car and pay $751 per month, you will end up paying $5,093 in interest over the course of the loan. So, how do you avoid this trap? The best way is to buy a used car, preferably one that is 3 to 5 years old and has low mileage, good condition, and a reliable history. This way, you can avoid the steep depreciation that happens in the first few years of a car's life and save a lot of money on the purchase price. You can also save money on insurance, taxes, and interest by choosing a cheaper and older car. Of course, you should still do your research and inspection before buying a used car, and make sure you get a good deal and a good quality car. The third money trap to avoid is not investing. Investing is one of the most powerful ways to build wealth and achieve your financial goals, because it allows you to grow your money over time and take advantage of the power of compounding. Compounding is the process of earning interest on your interest, which can result in exponential growth of your money. For example, if you invest $10,000 at a 10% annual return and reinvest your earnings, you'll have $25,937 in 10 years. $67,275 in 20 years, and $174,494 in 30 years. That's without adding any more money to your initial investment. However, many people don't invest or don't invest enough because they are afraid of losing money, or they don't know how to start, or they think they don't have enough money to invest. Only 55% of Americans own stocks, and only 37% of young adults aged 18 to 34 do. That means a lot of young people are missing out on the opportunity to grow their wealth and secure their financial future. So, how do you avoid this trap? The best way is to start investing as soon as possible, and as much as possible according to your risk tolerance, time horizon, and goals. The sooner you start, the more time you have to benefit from compounding, and the more money you can make in the long run. The more you invest, the more you can take advantage of the market returns, and the more you can diversify your portfolio and reduce your risk. You don't need a lot of money to start investing, as there are many platforms and apps that allow you to invest for as little as $1 or even for free. You also don't need a lot of knowledge or experience, as there are many resources and tools that can help you learn the basics and guide you through the process. Some of the best ways to start investing are to open a retirement account, such as a 401k or an IRA, and contribute at least 15% of your income, or enough to get the employer match if you have one, and to open a brokerage account and invest in low-cost index funds or exchange-traded funds, or ETFs, that track the performance of the stock market or a specific sector. The fourth money trap to avoid is living beyond your means. Living beyond your means is when you spend more money than you earn, or more money than you need on things that you don't really need, or that don't really add value to your life. This can lead to a lot of problems, such as accumulating debt, having no savings, having no emergency fund, having no financial security, and having a lot of stress and anxiety. According to the Federal Reserve, the average household debt in the United States is $145,000, which includes mortgages, student loans, car loans, credit cards, and other types of debt. According to Bankrate, only 39% of Americans have enough savings to cover a $1,000 emergency, and 28% have no emergency savings at all. According to CNBC, 78% of Americans live paycheck to paycheck, and 56% of Americans have less than $10,000 saved for retirement. These statistics show that many people are living beyond their means and are not prepared for the unexpected or the future. So, how do you avoid this trap? The best way is to live below your means, which means spending less money than you earn and less money than you need on things that you really need or that really add value to your life. This can help you save more money, pay off debt, build an emergency fund, invest for the future, and have more financial security and peace of mind. The fifth and final money trap to avoid is not having financial goals. Having financial goals is essential for achieving financial success because it gives you a direction, a motivation, and a measurement for your financial journey. Without financial goals, you're likely to drift aimlessly, waste your money, and miss out on opportunities. According to a study by Fidelity, only 43% of Americans have a long-term financial plan, and only 29% have specific financial goals. That means a lot of people are not clear about what they want to achieve with their money, or how they are going to achieve it. So, how do you avoid this trap? The best way is to have financial goals and to make them smart, or specific, measurable, achievable, relevant, and time-bound. This means that your financial goals should be clear, quantifiable, realistic, aligned with your values and priorities, and have a deadline. For example, you don't just say, "I want to save more money," but instead, "I want to save $12,000 for a down payment on a house in 2 years." This way, you can have a clear vision of what you want to achieve and how you are going to achieve it. And that's it for today's video. If you enjoyed the video, please give it a thumbs up and subscribe for more similar content. And don't forget to leave a comment below and let me know what are some of the money traps that you have avoided or that you're struggling with and how you're dealing with them. Thanks for watching, and I'll see you in the next video.